Hi, John Enright here from Custom Wealth Management in sunny Syracuse, New York, and I'm here to bring you through what matters in the financial planning world in the third quarter of 2020. Well, we've made it through another quarter of 2020. Only 1 month to go before we have one more month. Then it is just 1 month left until a month to follow. That pretty much sums up how I feel about 2020. I'm sure some of you feel exactly the same way. So I just want to take a second to acknowledge that this has been a hard year for absolutely everybody. The markets aside, this year has been a year that has challenged us as individuals, as parents, as sons, as daughters, as co-workers, as a community, and as a nation. We have been challenged in ways we probably never thought we would in today's day and age. My hope is that we'll come through this as better for having had these experiences. Maybe not in all the ways that we would like to be better, but if even in some small way, then we've spent our time and energy towards progress. With that said, let's get into what happened in the third quarter this year. Starting off with the economy, as many had predicted and even more had hoped for, the third quarter had a strong bounce back and actually better than most expected. It's widely forecasted that we will see a 19.1% gain in GDP. Some believe that this may even be conservative, with several of the predictions for GDP growth that are closer to 30%. This is actually nowhere near where we would need to be to fully recover from the 31.4% plunge that we saw in the second quarter. For that, we would actually need a 45.7% rebound to be back to where we were at the beginning of the year, and a 53.3% rise in GDP to get back to where we were at this time last year. While a 20 to 30% gain in GDP is certainly great, most indications show that the easy part of this recovery is over. While unemployment rate has come down, we have only recovered 52% of all the jobs that were lost, not including the 4.4 million people who have exited the workforce entirely. Most of these jobs are concentrated in the service industries, like leisure and hospitality, which is 19%, transportation 9.8%, and other services 9.2%. This is not surprising, as air travel is still down by a whopping 70%, and restaurant dining is down 43%. This is of considerable note, as the service industry is made up about 79% of all jobs in the US, and services as a whole account for about 42% of GDP. Moreover, many economists believe that without dealing with the pandemic, we won't be able to fix the economy, as the health effects of the pandemic continue to be drawn out. The importance of Congress providing additional relief measures grows, to the point that even Federal Reserve Chairman Jay Powell stated, in an uncharacteristically blunt manner, that without support, the economy could fall into a recessionary downward spiral. Moving on to equities or stocks, unlike the second quarter of 2020, the third quarter ended with investors feeling very mixed as to what might lie ahead, and offered both bullish and bearish cases for the near-term markets. Continuing growth of the second quarter, domestic equities had their best quarter since 1998. The 5-month rally resulted in many indices actually turning positive for the year. The markets fed off of an open tap of monetary and fiscal support from the central banks, better than anticipated corporate earnings, improving unemployment numbers, big technology's ability to thrive in a COVID economy, and further progress towards developing a vaccine. By late August, however, we could already foreshadow the deadlock that would subsist in Washington on another stimulus package. Stock valuations had become overextended, unemployment numbers began to plateau, and corporations were facing increasing earnings expectations. Come September, bears finally had enough, and they wrestled the control away from the bulls. In any other year, a 10% dip over a 3-week period would have dominated the evening news. But the confluence of global pandemic, continued racial protests, a Supreme Court vacancy, and the presidential election season, seems to have all but drowned out the decline, as this clawback barely registered for most Americans. Despite the volatility in the trailing weeks of the third quarter, the patient investor would have been rewarded as the S&P 500, international stocks, US bonds, and gold individually returned 8.9%, 4.8%, 0.6%, and 13.3% respectively. Most notably, from its bottom on March 23rd, the S&P 500 has gained 38.1%, recouping all of the value lost and then some from the pandemic-triggered sell-off. This brings me back to a point that I mentioned earlier, stock valuations. While the valuations have reached fairly high levels in today's markets, we do not see the concern being as widespread as it was during the dot-com boom. There's a rather large portion of the market that is reasonably valued, or actually even still undervalued, and we would expect to see improved fundamentals in those undervalued parts of the market, such as energy, financials, real estate, and even utility. If we step off the thrill ride that is the equity markets for the safe haven of the bond market, the third quarter was what we would have expected. The US Treasury yield curve basically remained unchanged, with the short end of the curve falling just 3 basis points to 0.13% on the 2-year Treasury, and at the longer end of the curve rising just 3 basis points on the 10-year T-note to a 0.69%, and rising only 5 basis points on the 30-year T-note to 1.46%. As the Fed has announced its plans to keep rates low, this will undoubtedly continue to keep mortgage rates down and the housing market strong. But the trade-off will be a sustained low interest rate environment for investors. Generating income from investments will continue to be the thorn in every investor's side, as bonds have all but exhausted a nearly 40-year bull market run. With rates so low, there are only 2 places to go for income. The first place to look would be further out on the yield curve, but as I just mentioned, the 10-year and the 30-year Treasury notes are not paying much more than what the shorter-term Treasuries are, especially when we compare these to 30-year Treasuries that were paying a whopping 15.21% at their peak back in 1981. So the only other place to turn is to head down the credit ladder or to get more aggressive with our bonds. Just like when a person's credit score is lower, they will pay a higher interest rate on money that they borrow, as they are deemed a higher risk. So too do borrowers in the bond market or corporations and governments that borrow money from investors, which means that in order to generate higher yields, you need to take on more risk. Not exactly a great option for the conservative part of one's portfolio. Assuming one is comfortable accepting some additional risk, knowing what you own, particularly in the bond market, is key. There are several positions out there that at first glance they would appear to be a relatively risk-adverse option with impressively high yields. Attractive at their onset, but if you peel back the layers as we do, you would find that some of these options, one broadly used in particular, has nearly 90% of its holdings in below investment grade bonds, and only about 5% in high quality instruments. Now, if you had held this position earlier this year, when the fund price went from a peak of just over $21 a share to a low of $10.49 per share, your performance obviously would have been worse than many of the stock portfolios, and considerably more volatile than what you were probably expecting. Keep in mind, this was the bond part of your portfolio. Compounding that loss is the fund's inability to fully capture the upside of the rebound because of the types of positions held within the fund, as this fund actually remains down about 21% year to date. This is a strong reminder of why it's imperative to view your portfolio with a long-term lens and structure with an amount of risk that can comfortably tolerate future volatility. Lastly, I'd like to touch on the upcoming elections. This is no doubt a high-stakes election for a lot of people for many reasons, but for investors, they should consider this yet just another Tuesday. A couple of helpful visuals that I wanted to share with you about the election. If we look back at the markets post-Great Depression, there have actually been 7 Democratic presidents and 7 Republican presidents. Over that 85+ year period, the general market direction has been positive. Now, if we broaden our analysis to include the executive and legislative branches, we can see how it's not necessarily who is in charge, but that there's continuity across the branches that has the biggest impact on market returns. Looking at the rolling 6-month return for the S&P 500 for each calendar year and how the government was made up during that time, such as an undivided Republican, undivided Democrat, or a divided government, what we see is that the market can perform regardless of the party in power, but what it really dislikes is not having the predictability that comes with a single party in control. In the case of the current election, many have thought that a change from Republican to Democrat would lead to a downturn in the markets. But what we've actually seen is that as the odds of a Biden win have been increasing, the markets have actually experienced strong results, with last week being the strongest week since July, even as the betting line for a Biden winner reached a new peak, leading us to presume that Wall Street is becoming increasingly comfortable with a Biden win in November. Even if we look at election years specifically, we see that the market has been positive 19 of the last 23 election years dating back to 1928. Furthermore, studies have shown that those who remain fully invested during a full election cycle tend to outperform those that sat on the sidelines. What should matter to investors is not who is president, but rather where their money is actually allocated. Despite this, the average flow of investments into safer money market funds dramatically increases in the years of presidential elections. A diversified portfolio doesn't care much who sits in the Oval Office. Staying committed to your long-term objectives will have a far greater impact on your portfolio than whomever is elected president. Let me close with a very brief comment on coronavirus. If you're interested in following the progress of the vaccines, check out the New York Times Vaccine Tracker. As of October 7th, there are 44 different clinical trials, 11 phase 3 trials, and 5 approved for early or limited use. This is absolutely incredible news given the history of vaccine production. I want to thank you for taking time out of your day to share with us, and please never hesitate to reach out if you have any questions. We at Custom Wealth Management would like to wish you and yours the very best for an enjoyable holiday season. Thank you.